Hello and Assalamu alaikum everyone. Welcome back to Commerce Simplified Business Foundations for Everyone. This is your instructor Muhammad Hassan, and today's video is about basic accounting concepts. Now, don't get worried because we aren't going into complex calculations. The goal here is simple: to understand how businesses track money and make decisions using accounting. Let's start with a basic question: why does accounting even matter? Accounting is basically the language of business. It helps answer key questions like how much profit did we make, where did our money go, and what do we owe. The information helps in three major ways. Number one, decision making. Managers use financial data to provide pricing, investments, and cost control. Number two, compliance. Businesses need proper records for taxes and legal reporting. And lastly, trust. Clear financial statements build confidence for investors, lenders, and partners, which we'll be studying in our seventh video as well. Now, let's talk about three main financial statements every business uses. Number one is the balance sheet, which shows what we own, known as our assets, what we owe, known as the liabilities, and what are our total possessions, what we know as equity or capital. So the balance sheet follows a simple account. It's a basic accounting equation. What we know as assets equals to liabilities plus equity. Number two is the income statement, which shows performance of a business over a period. It tells us that revenue minus expenses equals to the profit or losses. Number three is the cash flow statement. This tracks actual cash movement inside a business and outside of the business as well, which helps us understand liquidity. Together, these three give a complete financial picture of a business, which shareholders might use. Now comes the backbone of accounting: double entry bookkeeping. Every transaction affects at least two accounts, one debit and one credit. This keeps everything balanced. For example, if a business makes a sale on credit, accounts receivable, which means that we're gonna receive money, is debited because it is our asset, and sales revenue increases, which is credit, right? Or if the business pays a supplier, so accounts payable decreases, which was our liability. So when liability decrease, it is gonna be debit, and we are paying cash, right? Cash is our asset, so cash is gonna be credit. This system helps reduce errors and ensures accuracy. A business uses two main ways to record an accounting transaction. Number one is the accruals concept, which means revenue and expenses are recorded when they are incurred or earned, regardless of the cash consideration. This helps in giving more of an accurate picture of a business. Number two is the cash counting. This records only when cash moves, when we receive cash or when we pay cash. It's simpler but less useful for a longer period of time. Most of the large businesses over the world use accounting concept because it reflects the reality better, regardless of the cash consideration. Okay, so now let's learn accounting step by step. Number one, transactions are recorded in journals in the form of double entries, which we studied before. Number two, they are posted to ledgers, or what we know as T accounts. Number three, a trial balance is prepared to check the accuracy that the debit side of the transaction should definitely match the credit side of the transaction. After which, adjustments are made for accruals and prepayments or corrections, what we studied in the previous slide. And lastly, financial statements are prepared. These financial statements are then released for investors to look out for potential investments. Okay, so three important accounting rules or concept which a business must follow. Number one is the matching principle. Your expenses should be matched with the revenue of a current period of time they generate. Number two, conservatism. When unsure, record lower profits to avoid overestimating performance. Number three, going concern. We assume that the business will continue to operate in the foreseeable future. These concepts keep accounting realistic and in control as well as consistent. Okay, so let's simplify these concepts using an example. A business starts with revenue, right? From that, it subtracts cost of goods sold, then operating expenses, and then interest and taxes. And what remains is our net profit, or if in minus, it's our net loss. The most important figure for owners, investors, and every sort of stakeholder. This is how business measures their success, mainly on monetary basis. To make accounting reliable, businesses follow certain practices. They use internal controls like separating duties and approvals to reduce fraud and errors. At the end of each period, they perform closing procedures and they follow a reporting schedule in which monthly reports for management are reported to the superior management. Quarterly tax filings are done to the tax department, and annual financial statements are prepared, which include income statement, balance sheets, and cash flow statements. Consistency here is key for planning and growth. To conclude, accounting is not just about numbers. It's about how business activities turn into meaningful insights. It helps businesses stay accurate, build trust, and make better decisions regarding their future. Uh, if you understand these basics, you already have a strong foundation in accounting. So let's wait for the next video. Thank you for watching. Allah Hafiz.